All right, I think we are ready to get started with our final panel of the evening, looking at some of the global implications of Dodd-Frank. We are going to be taking a look at not just the lessons that we've learned over the past decade, but also focusing on, what we have figured out has worked from a global perspective, what needs to be improved upon, and how some of the dynamics have changed internationally since Dodd-Frank was put in place during the financial crisis. A couple of housekeeping notes as we begin here. First of all, for those who are just tuning in, viewers can submit questions for this panel for the speakers by emailing events@brookings.edu or by joining the conversation on Twitter using hashtag DoddFrank10. In addition, we do have one member of the panel who was unable to join us, unfortunately, and that is Nathan Sheets. But we do still have an all-star roster who's going to be joining us for the next 50 minutes or so. We have Gary Gensler, former head of the CFTC, now at MIT, Don Cohn, former vice chairman of the Fed, now a member of the Financial Policy Committee at the BOE, and of course, a senior fellow at Brookings. And it's also our pleasure to have SEC Commissioner Hester Pierce. So we have a lot to cover in just a little bit of time. And I'd like to start by talking about the Financial Stability Board, which is one of the institutions that was set up following the global financial crisis, one of sort of the outgrowths of the international consensus for coordination post Dodd-Frank. And, it seems like one of the first priorities and the main priorities of the FSB was really to ensure the stability of the global financial system. And it seems that during this pandemic, it appears to be working as of now. So I'd like to start with an unusual question, which is, what did the FSB get right? Or what did sort of our international regulators understand in setting up the FSB that has allowed it to work during this crisis? And then we can go on and talk about ways that it can be improved. Just open that up to the panel just to get started.
So maybe I'll start, Ilana. I think the FSB was, as you said, one of the great things to come out of the global financial crisis, badly needed going in to get coordination and cooperation among regulators and some uniformity or some consistency across jurisdictions. We operate in a global financial market. In 2007, 2008, the earthquake started in the US, but quickly spread throughout the world. Here, we have a pandemic that's spreading throughout the world. So I think the imperative is to get the global financial regulators talking to each other and lining up their regulations approximately the same, and doesn't have to be exactly the same, but making sure that financial stability is protected in all the key jurisdictions. I think an important point here, which you brought out, was that this had the support of the governments. So it started really in the fall of 2008 at the G20 Pittsburgh Summit, where Financial Stability Forum was discussed and how it needed to expand. And by the time April of 2009 came around, the Financial Stability Board was created with additional powers. But the important point is that the heads of government of the G20 countries were behind it, and that's what gave it the force to be successful. And we can come back to the global successes and failures right now, but later. But I think it's been very successful in banking, basically supporting the Basel Committee on Bank Supervision and encouraging that committee. But in the non-banking financial markets, I'm not sure it's been that successful. We had some pretty bad seizing up of markets in the US and elsewhere.
I don't know if you wanted another view, but just for our listeners, the Financial Stability Board is not the only international organization. And I think it came together out of a G20 effort, as Don said, in Pittsburgh in 2008, seeing the crisis unfold, seeing all the problems. There were already international ways to convene. In the securities field, IOSCO had been doing this for decades. In the banking field and capital field, both between the Basel Committee and the Bank of International Settlement, and on and on. There are other committees. OECD even did some things in standard setting. I think what the FSB was able to do is bring those various slipstreams, bankers, finance ministers, securities regulators in one area. And then twice a year initially, they had to report up to heads of state. And so it sort of, for a while, elevated it and brought a bunch of folks together. I think secondarily, they also had resources. I'm not entirely sure of their funding, but they have some really good staff, and they put out some good research and the like. And now I think it's run by Randy over at the Fed. It had been run for a while out of Mark Carney in the UK. I think there's been some good leadership as well over time, but I really would stress there's a bunch of other international organizations, and most of the wood gets chopped in those other organizations, I think. Not to diminish the Financial Stability Board.
Sure. Hester, if you can weigh in here, what does that international cooperation look like from your standpoint in the midst of responding to this?
You're muted, Hester.
My views represent my own views and not necessarily those of the commissioner, my fellow commissioners. I wouldn't want that to be muted out. But the FSB, I think, has been a really important convening place for regulators and central bankers to come together and talk. And I think, as Don pointed out and as Gary pointed out, this is something that was developed in advance of the crisis that we're in now, and the relationships that are fostered at the FSB and at these other international organizations have really come into play at a time like this, when we all need to be talking to each other and at least understanding where one another comes from. And so from my perspective, that's really the most valuable piece of it. It's to learn from one another, it's to talk to each other, share experiences, and having those strong relationships means that it doesn't take a lot to pick up the phone and call someone. We have frequent calls. I'm part of one of the FSB subcommittees. We've had frequent calls over the past several months. We can't get together anymore, as no one can anymore, but we stay in touch by phone, and I've found it personally very valuable just to learn what's going on in other countries and what they're thinking about in terms of addressing the problems that we're all facing.
I think what Hester's saying is critical, that there's some relationships that are formed before you get into crisis, because when you're in the foxhole, it's good to know, not just who to call, but how they work. And there are different cultures and different politics around the globe, and where they can move, and sometimes, frankly, where they can't move. Maybe they don't have statutory authority, or maybe their local markets are sufficiently different that we have to be respectful that there's some differences. We can't both do the same thing.
Hester, just curious, what have you found to be the most useful channel of coordination and cooperation during this current time? Has it been the FSB, or is it another institution or organization? Where do you see you personally working most closely with international counterparts?
Well, as Gary pointed out, there are a lot of different international organizations, and for us as a securities regulator, IOSCO is a big central piece of our international work, and we've had relationships through IOSCO for years, and so that's really a key place for us. I personally have been more involved on the SCAB, on the FSB, on the SCAB, which is one of the subcommittees, and so that's for me personally been a more active place. But I would say that we have lots of bilateral relationships as well, and those are very important too. So I think it's a mix, and one of the important pieces of being part of so many different types of cooperation is that we have to moderate the pace and make sure that we're all coordinating and make sure that we're not doubling up on work done in one entity. We don't need to do that same work in another entity. We can draw on that work. And so that I think that's a continuing challenge, right? When you set up new bureaucracies, new organizations, it can be hard sometimes to say, okay, we're going to get you to focus on this piece and we'll get this other group to focus on this piece. But ultimately, a lot of the work gets done by our staff at the SEC. And I think I've been really impressed with the way that our staff has been able to do so many things during the crisis. You know, we're running our normal regulatory work. We're working on domestic COVID issues. And then they're also contributing immensely to the efforts of the FSB and IOSCO and other international groups. So it's really a testament to the work of the staff.
I think several of you all have mentioned sort of the work on that FSB has had in supporting Basel III. I believe they put out an estimate of bank capital requirements have sort of doubled since 2011. Can you talk a little bit about that focus and how important the increase in the capital buffers have been internationally? Maybe start with Don.
I think the increase in capital buffers has been hugely important, and liquidity buffers as well. So the banking, as others have said in previous panels, this is not a financially originated crisis. It's coming from the health, but it's having financial knock-on effects. And I think it's important that the financial system be able to contribute to keeping the economy going, keeping credit flowing from savers to spenders, so that we're not taking a health crisis and making it even worse because the credit system is freezing up. And the increase in bank capital and bank liquidity has made those banks safe. And in most countries, certainly the US, the UK, Eurozone, the banking system is being used to get credit to businesses who need it to reduce the scarring from the crisis, to enable the businesses to keep people on board, to enable them to open up later. So banks have been have made a very positive contribution to trying to make it through this horrible situation that we're in and minimize the damage coming back the other way. And that would not have been possible without the previous reforms that made them safe.
Can I ask Don a question rather than answering that? There was in earlier panels today, there was this debate about whether capital buffers and increased capital was the result of US Congress action through Dodd-Frank, or was it happening apart from Dodd-Frank, in essence would have happened in any event. And there was some lively, Janet Yellen weighed in a different time, Barney Frank himself weighed in, but Andrew, I think Ullman raised it earlier on. So Don, what was your thoughts on that?
So I think the Fed and the other banking regulators, let's leave it on the banking side, we're in the process of raising capital and forcing the banks to raise capital. And the stress tests in the spring of 2008 were a key time at that. So for sure, they were on the way up. But I thought Dodd-Frank, and I think one of the panelists made this point, gave the legislative push, the legal underpinning for continuing that process. It mandated the stress test. It mandated making sure that particularly that the systemically important institutions were safe, because their failure has greater costs for the economy than the failure of a smaller institution. So I think Dodd-Frank was key to taking a process that might have been going on in any case, but making sure, as it should in a democracy, that the legislature was behind that process, pushed that process forward, and bringing it back to the first issue about the FSB. I think the FSB, because the US financial system is the central financial system for the world, that the FSB success depended on the US success. So Dodd-Frank, by pushing the US system forward, helped to push the global system forward as well. It was, as others have said, the needs were recognized, but you have to put the processes in place and move forward. And I think Dodd-Frank was important globally as well as in the US.
Don, you've also brought up the point that not all countries are sort of progressing equally, or they're not progressed equally over the past decade, despite the level of coordination we've seen at the FSB and other organizations. Does it matter if, for example, the US is not moving along as quickly on capital requirements as the UK is? Does it matter if the US's stress tests are perhaps not as rigorous as what we're seeing in the UK? Does that make a difference?
What makes a difference is if the US is vulnerable to financial instability, because when the US is unstable, the global financial system is unstable. So whether a capital requirement is a point here or a point there, a liquidity requirement, it's better. I mean, there's regulatory arbitrage, so it's better that they be roughly lined out. But I think the underlying issue is keeping these key systems stable when bad things happen, when shocks hit. And that's what we're seeing right now.
Yeah, I mean, it's a little bit like this virus. Money and capital knows no border, in a good way, but sometimes in a negative way. And the virus knows no border as well. And so I agree with Don, but I'm going to turn to like securities and derivatives law and so forth. We do have different political systems, different cultures, different financial markets. So we had to recognize in the midst of rule writing and in legislative initiatives that we might be a different place in the US than elsewhere. We did great work, and again, through the Financial Stability Board, through IOSCO, but mostly with Michel Barnier, who more recently negotiated the Brexit deal, but he was in a position in the European Commission at the time to negotiate with all of us who were doing our jobs in the earlier era of rulemaking, and to coordinate with the Europeans. And we found if Europe and the US was roughly aligned, and then hopefully if Canada, Australia, Japan were with us, that was a pretty good, I mean, we wanted Hong Kong and Singapore. We were realistic, particularly in some of the securities law and the derivatives law, that China's markets weren't as developed then as they are even now, 10 years later. But it was really important, I felt, and I think all of us felt, that if we could come along together, roughly together, it was important, because capital risk knows no boundary. AIG, if we not forget ourselves, failed because of a subsidiary of theirs in London, AIG Financial
Products.
It was called, which was actually.
Well, there was a little bit of other stuff going on at AIG as well. It was there were securities lending issues as well.
Well, Hester, if you could,
among other things.
I mean, I feel like what I'm hearing is that there's a lot of pressure on U.S. regulators like yourself in order to get it right. Can you talk a little bit about that challenge? And if the U.S. essentially, if you don't get it right, then that means that the rest of the world may not be able to get it right. So how do you approach that mindset?
Well, I think it is important that we get it right, but I'm not sure that everyone else has to follow along exactly with what we do. I mean, I've always been a proponent of the view that we have individual jurisdictions for a reason. We have our own sovereignty and we can make our own decisions. We inform ourselves by talking with our international counterparts. It's really important for us to have those discussions. And I believe that that's really important, but ultimately we're trying to get it right here. I personally have been working on finishing a piece of Dodd-Frank, which has taken quite a long time, which is our regime for security-based swaps. And that is a market, as Gary said, that knows no borders. So we've been doing a lot of thinking about how our rules would affect foreign entities that work in the United States. And we're trying to develop a substituted compliance regime, recognizing that another country's regime doesn't need to look and act exactly like ours in order for it to be an effective regime to achieve the same objectives that we're trying to achieve. And that concept of being willing to defer to judgments that your international counterparts make is a really important one. And I think we have to be careful not to lose that. But at the same time, it's really important for us not to be told by our international counterparts what we have to do here in the United States. People sometimes have very strong feelings on these topics, and they're sure that rules that are developed in one place are perfect for another place. I don't always subscribe to that. I think another really important point to remember is that Dodd-Frank introduced a lot of complexity into our financial regulatory system. And I think the jury's still out on whether that's a good thing. I would say that there are some really negative consequences of that. It really is. It is bad that that we have such a complex system that it's difficult for anyone except for the regulatory folks who are very much in the weeds to understand what's going on. And even those of us who are more in the weeds than others, there's a lot that we can't know. And I think that humility, the need to have regulatory humility and to try to instead build in incentives, market-based incentives, so that the market itself can react and can discipline itself and correct itself, that's much more likely, in my view, to be a long-term successful solution. And the complexity problem, I think, gets aggravated sometimes in the international context, because if you try to get everyone on the same page, exactly the same page, then you've got everyone walking in exactly the same direction. And if there's a decision that wasn't right, then we're all going to go down together. Whereas if you have a little heterogeneity, it can actually be a stronger and more resilient financial system. So I think we need to remember that that we don't always have to be entirely uniform, and that a little diversity can be a good thing.
So I'm going to agree in part, and then highlight one area that we might have a debate or difference. I agree, heterogeneity is really important, and uniformity is often a path towards financial fragility or instability in markets, or the correlation of everybody doing the same thing. But there's a time in the weekend, which is 8 p.m. on Sunday night, which every regulator that has dealt with a crisis knows, and it's when the capital markets open in Asia. And so it's that we're such an interconnected global world where most international banks have 1,000 to 3,000 legal entities. Their complexity also matters. I'm agreeing with Hester on this. But at 8 p.m. on Sunday night, if something is going on in a US affiliate in Japan or a European affiliate in Japan, it will bring the whole thing down. And so that's the interconnection. Barney Frank reached out in the middle of writing Dodd-Frank to both the Securities Commission, SEC, and the CFTC, and said, how do we deal with the Lehman Brothers and AIG issue? Because AIG was operated out of London, and a lot of what happened at Lehman was actually offshore. And he wrote, his staff wrote, with some help from the commissions, some words, simple words, into Dodd-Frank, which became Section 2I of the Commodities Act, about, and I won't get the words exactly right, but if something had an effective or significant effect on US commerce or business, then it was somehow underneath this. He was trying to capture the AIG. And from those 16 simple words, and though we might not have gotten it all right at either of our agencies at the time, we tried to then write guidance and rules about that. How do you cover the offshore affiliate and what Barney used to call the flowback risk? The risk would flow into these shores and hurt our public jobs and homeowners. And that's the tricky part. It's not easy. It's a balancing act. There's a lot of trade-offs. But I do think what Don said about regulatory arbitrage, I was at Goldman Sachs for a bunch of years. My last role was co-head of finance, and we at the time had 700 legal entities. But, I learned a little bit about regulatory arbitrage, and always legal, but so.
Well, so we can blame the complexity on you. But I think one of the things that's very tempting is for us, because we are such a large market and because a lot of things that happen around the world can have an effect here, and US investors participate in lots of things all over the world, I think there can be a real temptation for us to try to reach our regulatory fingers into places that maybe they don't belong. And so we, again, I mean, I harp on this word all the time, but I think regulatory humility is also important for us in that regard, that we can't set the rules for everyone else. If people want to go and avail themselves of other markets, then they don't get the protection of our rules. And so if they want to come to our markets, then our rules apply.
Even though you're closer together, particularly if it's like a Japanese bank or it's Deutsche Bank, but when it's an affiliate of one of these large banks in the US that Don's old colleagues or maybe have, oversight of, then I think that risk can flow back and hurt our public in a real way.
We talked about the importance of heterogeneity. We talked about the importance of, at the same time, international consensus. We are in a political moment now where there may not be the same level of international consensus that there once was, where there's skepticism of global institutions, and that there is, especially in the US, a real desire to put America first. So I was hoping that you guys could talk a little bit about how the global political dynamics have shifted over the past 10 years and what that could potentially mean for international financial regulation.
I've been, it's well known to probably your listeners that I'm served in a Democratic administration. I've been reasonably pleased watching this administration in the financial sector, whether it's the SEC, whether it's the Federal Reserve, whether it's the agency I once had the honor to serve at, that there's still a real focus on international dialogue, coordination, and so forth. But you're right that whether it's trade negotiations, whether it's climate change, I mean, the list is quite long, that we seem to be a little bit more fractured now. But in terms of financial regulation, the relationships among central banks through this pandemic has been very close and coordinated. I think the relationship, I'm not living it as Hester is every day, but the relationships between the securities regulators, I think is to their credit, has been pretty close globally, but others might comment.
Yeah, no, I would agree with that. I mean, I think we've been working very closely with our international counterparts. Chairman Clayton is very much in communication with his counterparts all the time, and I think it's a really healthy relationship. We work very well with lots of different countries on a bilateral basis. We have all kinds of coordination on enforcement and regulatory matters. And I think that's a wonderful thing. But on the other hand, I think there's a pushback against some of these international organizations when they try to tell us and prescribe to us what we have to do. And that's something that I push back on all the time. As a regulator, take my directives from the statute that governs me. And so I have to follow that. And that statute is a product of democratic deliberation in Congress. And so we can't have a system where you have an international body setting a directive and saying, okay, you in the US, you've got to go do this, which is basically telling Congress how to write a rule, or telling us that we have to ignore what Congress told us to do and do what this international organization told us to do. And that's not a tenable situation. So while I think the SEC, including me, we're all very committed to having these solid international relationships and to learning from one another and to sharing information, to trying to help one another to have these strong relationships, it doesn't mean that we take our orders from an international organization. We legally cannot do that.
So I agree with you. She can't, as she said, the SEC has certain laws and regulations they need to enforce themselves, or they need to promulgate and enforce. I think we should focus on outcomes rather than the specific regulations. So I do think the international organizations are appropriately worried if they don't think the US is protecting its markets or its banks, its institutions sufficiently against certain kinds of risks. And you're right, Hester, they shouldn't tell us how to do it, but they should be able to say, look, we think what you're doing is exposing the global economy, is exposing our people as well as yours to risks. What are you going to do about it? I think one of the issues I've wondered about, and it's a good chance to ask Hester, is the SEC, most US regulators don't have a financial stability mandate. They have particular mandates for protecting investors or whatever. And I've wondered whether giving the SEC, the CFTC, even the Fed is perceived to have a financial stability mandate, and it has acted to stabilize the financial system, but it's not written into the law that the Fed has. So it's ambiguous and ambivalent to a certain extent. So I wondered whether you thought it would be useful if US regulatory agencies had, in addition to their other requirements, a financial stability mandate. And I'm hoping, if you say yes, I was going to carry that back to FSOC and how to strengthen FSOC. So
I think that the mandate that we have is really nicely consistent with our role as a capital markets regulator. So the capital markets are intended to be places where people go and they take risk. And so capital markets are very different than our banking markets, and that's intentional. And so it's not surprising that when you move risk out of the banks, it comes into the capital markets. And we in the US have such strong and robust and diverse capital markets that it enables people to do all kinds of really interesting things that, frankly, other financial systems don't support. And so I think if we import a financial stability mandate into what we do, it does risk impairing the ability of our capital markets to function the way they do. Now, we think about the strength of our institutions. We have net capital rules for our broker dealers, for example. We're thinking about those kinds of things, but ultimately, I think capital markets go really nicely with competition, and they're intended to be a place where, an institution might be here for a long time and might contribute a lot, but there's room for new entrants to come in and to shake things up and to offer new products and services. And so I worry that if you start thinking too much about stability, what you end up with is a few really large institutions that we have really tight relationships with, and that then, we help prop them up. And that's certainly not what I want us to be doing. I want us to be developing a really competitive, dynamic marketplace that serves all sectors of our society, that really brings in new ideas and allows these ideas to flourish. And so that's what I'm most excited about when I think about our capital markets.
Yeah, so I certainly agree with that objective, but I'm wondering whether when the capital markets themselves freeze up and require the Federal Reserve to come in, as it did in March, whether that doesn't suggest that as part of this very competitive, innovative market, there are some systemic issues that should be addressed by the regulators. We shouldn't have to rely on the Federal Reserve to backstop markets, particularly, or if we do, there ought to be some oversight of those markets, some greater oversight, so that the occasions when the Federal Reserve needs to come in, twice in the last 12 years, are fewer and farther between.
Well, I think there's going to be time and a need for a retrospective review to understand what happened and how different things worked and didn't work during the last several months. Some people attribute some of the problems that we saw and some of the need for the Fed to come in and intervene to the fact that there were rules that were set up during the last crisis that didn't really work. And in fact, before this crisis happened, there were a lot of complaints that that certain activities were being squeezed out because of certain regulations that flowed from Dodd-Frank or from other related regulatory efforts following the last crisis. And so I think it's worth us sitting down and trying to figure out where the problems are. And again, looking at also at our rules to make sure that we have rules in place that allow entities when there's a problem to fail and not, I mean, failure of any financial entity is likely to cause some problems. It's not going to be without problems, but to minimize those problems and allow that entity to disappear and a new one or multiple new ones preferably to come in its place.
What do we know about the international experience? What are the international regulatory agencies that have a financial stability mandate that may have seen better outcomes than the US has?
Well, I think that what we have is, and it was talked about on panels earlier, we probably have more financial regulators. We're one of only two countries, I think Japan and ourselves, that have two market regulators that split derivatives and securities. We have at least three bank regulators, FDIC, OCC, and the Fed, but in fact, we have the Credit Union Authority, we have others, and so, it depends how one counts. And then we have the GSE regulators and the like. So I think what we find is in other jurisdictions, we tend to have fewer. And then the other question overseas is often, are they sort of accountable more to their politically elected branch? We just had a Supreme Court case on this week in terms of whether the director of the CFPB can be removed with or without cause. But the so-called independent regulatory agencies in the US are very accountable ultimately to the public, but in other jurisdictions, they're more accountable more directly right into finance ministries sometimes. So there's some different architecture around the globe on these things. In terms of financial stability, it's usually the central bank and not the securities regulator. I'm not aware, maybe Hester knows, but I'm not aware of capital markets regulators. Maybe you know better. Did the Financial Conduct Authority in the UK or ESMA for Europe have such systemic I think the differences are more about those first things. We have a lot more regulators than they do, and sometimes theirs are more directly accountable into their finance ministries.
One of the other major focuses of Dodd-Frank was to try to limit the Fed's ability to bail out individual institutions through restricting 13(3) authority, for example. But one of the things this pandemic has shown is that there are ways around that. Right now, the Fed is buying bonds of apparently Walmart and Coke and Boeing and others as well. Other central banks around the world have expanded into buying ETFs and REITs and bonds for individual banks. Was restricting the Fed's ability to help individual companies a mistake from Dodd-Frank? Is that something that now in this pandemic we're realizing, that there needs to be more flexibility on behalf of central banks? How do you guys see that?
So I'm going to I'll go and Don. I think this is a debate since the founding of our nation. When Hamilton went to Congress and President Washington supported him over Jefferson to set up the first bank of the U.S., and then we had a second bank of the U.S., just a matter of history. One of the reasons, not the only reason, but one of the reasons that President Jackson, our seventh president, sort of got rid of that whole thing was because they were lending and they were involved in private capital flows and private capital markets. Now, I'm not saying the next 75 years were a good set of years in the wildcat banking era or anything like that. But when the Federal Reserve was set up in 1913, and with all its changes over the decades, over 100 years, it's really been sort of trying to stay aside the capital markets and let the pricing, let the allocation, the winners and losers, both on the investing side and on the borrowing side and the innovating side, be away from the central bank and the government. That's kind of that's our core. I think it crosses party lines. I think that's our core sort of philosophy. And then the 2008 crisis was more specific about a sort of a real mood in Congress and in the public. Why are big banks getting bailed out, and maybe the automobile companies, but nobody else? And so I think Congress reacted, but I think they were reflecting the public's mood, frankly, on that. But Don probably has a more, there are people at the Federal Reserve that wish they had not had that restriction put in there.
Well, Gary, I was one who worried about the 13.3 restrictions and how it might constrain the Fed in the next crisis. I think we've seen that it didn't. It hasn't, right? And that's because the Treasury and the Congress acted very, very rapidly to recognize the dire situation when you slam the brakes on a good part of the economy and what might happen as a consequence, and how that was echoing through the financial markets. So that doesn't mean, so this time it didn't matter, these constraints, but I'm not sure about the next time. It's very, very tricky, of course. You want to be responsive. I agree that keeping the Fed out of making decisions about who gets funds, who doesn't get funds, it's not a place where the Fed is comfortable, right? So our 99% of the time, the Fed was dealing with the Treasury or Treasury guaranteed agencies and wasn't making these other decisions. And I think the Fed's attempt to structure a bond portfolio that is broadly representative is another way of trying to get out of making those decisions. Who should get it, who shouldn't get it. They're buying the whole portfolio in the corporate bond market. So it is uncomfortable. It may be necessary under certain circumstances. I think it's important, as somebody pointed out on an earlier panel, that restricting the 13.3 to individual corporations, the AIGs, the future AIGs of the world, went hand in hand with the resolution authority. So hopefully the next time there's an AIG, it'll be taken care of under Title II of Dodd-Frank. It'll be put in the resolution and not have the Fed being forced to lend to this thing to keep it alive. We could lend, perhaps, I can't get out of the we for the Fed. So the Fed could lend perhaps to one of the surviving entities, but a way of dealing with those individual corporations that got themselves in terrible trouble by taking risks without putting taxpayer money at risk was really important. So I think the resolution part of Dodd-Frank was critical to making the 13.3 work.
And it's not as if, Congress did weigh in recently in the CARES Act and said they wanted Treasury. I don't think it's the Federal Reserve, but Treasury to make certain funds available to the airline industry. And whether you're for that or against it, at least it was our representative body, people who vote, it's Congress. Right. And again, you can debate both sides of that. That's different than having a monetary authority then take their enormous balance sheet and then pick winners and losers.
I agree. And even where the Congress said, we want the Fed to be making credit available, they wanted the Fed to be using the Treasury backstop that they gave it, the extra $450 billion, as a way of saying, we want the Treasury involved in these decisions, at least setting the risk parameters. And I think that's perfectly appropriate.
We have just about 10 minutes or so left. So I just want to remind viewers, if you do have any burning questions you want to get in before the end of the panel and the end of this session, you can submit your questions by emailing events@brookings.edu or by joining the conversation on Twitter with the hashtag DoddFrank and the number 10. We started the conversation talking about bank capital requirements, and it looks like due to COVID, the sort of implementation of Basel III is going to be delayed at least for a year or so. Does anyone think that's going to have a significant impact, or is that something that's to be expected given the level of the crisis we're currently facing?
I understand it, and it may even be a prudent trade-off, but I do think that things are going to get worse before they get better. And then this might not express itself in terms of the job numbers, but I think we haven't yet seen the significant household delinquencies and defaults. Congress has stepped in with $2.5 trillion of support. They're likely to put another infusion into the system in the next 6 weeks. But at some point in time, with 20 plus million people out of work, there's going to be a lot of people that can't pay their mortgages and auto loans and so forth. There's going to be a tremendous disruptions in the commercial real estate markets. And of course, we talked earlier on a panel, Janet Yellen was articulate about leveraged loan markets and the like. And I think that's going to wash back into the banking system in some way. Both the consumer delinquencies, the commercial real estate, the leveraged loan marketplace. I think it's going to be a pretty tough winter and spring of 2021. So I'd rather make sure that the financial sector is as prepared for that as that. I think that shock to the system has not fully been felt yet by the financial sector. The banks is really what I'm talking about.
So I agree with Gary, and that's one reason why I was hoping the Fed would come down a little tougher on the bank dividends. So I think Hester, to pick up Hester's theme about humility, we don't know what's going to happen. It could be really bad, both in household and business bankruptcies. Having enough, and we've talked about how the banking system has been a strength of the response to the virus and the economic impact of that. I think we need to keep it that way. So I was hoping that the Fed would basically force the banks not to pay out their profits, to retain it. Yeah, that might be extra capital they don't need, but I'd rather have them with extra capital they don't need than not enough capital and have them start cutting back on lending at the wrong time. On your question, Elon, about Basel III, I think postponing that is fine, and finding ways to encourage banks to use the capital they have. So I'd like to build the capital, and then I'd like to encourage them to use it to keep US households and businesses afloat through this horrible crisis as best they can. So postponing that's fine, provided you don't lose track of the ultimate goal, which is to rebuild that capital once it's been used, so the banking system is safe and can participate in lending again down the road. But postponing that and getting them to use the buffers they've built up to support credit flows, I think is very important. So using the buffers now, rebuilding them later, I hope the regulators don't lose sight of what I think one of the major lessons of coming out of the last crisis was, which was the banking systems that rebuilt their capital fastest, US and some others, were much more able to support economic activity going forward. And postponing the rebuilding of the capital once the crisis is over was just left us a weak banking system, as you saw in many European countries. So use the capital now, but rebuild it once the crisis is over.
This question may be jumping the gun, but I think it seems to be a good place to end the conversation, which is, as Gary and Don, you guys both pointed out, there's still potentially a long way to go in the fallout from the pandemic. But eventually, hopefully, things will get better. There will be a vaccine, we'll contain the virus, and there will have to be an unwinding period. What have we learned about the best way to go about that unwinding from the experience of unwinding some of the supports from the global financial crisis?
So I think what we found is There's some support, central bank support particularly, that's relatively hard to unwind, and some that's more susceptible to being unwound. Frankly, the TARP support got unwound sooner than the significant balance sheet support that many central banks did, the QE1s, the quantitative easings 1 and 2 and 3s and so forth. I think it will be a long time. The central bank in the US has a $7 or $8 trillion balance sheet now. In 2008, it was 1/10 that size. It was about 4 trillion just 5 months ago, and it's doubled in size. So it's using that balance sheet. I think necessarily it's using it in the middle of this crisis, but it will probably be a long time. And I think our jobs recovery and our economic recovery, unfortunately, is probably more likely years than just, months or something. So it's going to be a long kind of recovery. Hopefully, God willing, it's really robust recovery in 2021, but I think it's long. And it'll be hard to unwind those things. I think on the congressional, the fiscal support, it will be hard it's going to be hard, whomever wins the presidency in November. What do we do when many of those programs that Congress put in place run out? And they have different timelines and so forth, but there'll be a lot of desire to kind of keep them going. And while we have a significant fiscal ability, it's not unlimited. We can't be kind of just tapping the U.S. balance sheet for trillions of dollars every quarter. And so that's gonna also most likely come down at some time.
Hester, Don, final thoughts? Does it matter if countries unwind at different paces and at different times? As they will likely, depending on
at the SEC, I think what we're most focused on is just making sure that the markets are able to be up and running, and they've performed very well during the last several months, which is a great thing to see. And we're committed to keeping them open so that people can participate in the shift of things back into private hands, right? And help with the rebuilding of the economy through our capital markets. And so providing relief where that's necessary to do that. And then once that's through, then we'll go back and we'll look at what we learned from this time. But from my perspective as a securities regulator, I'm staying out of what the Fed needs to do to wind down out of.
She's not only a wise a policymaker, she's a wise political actor. But the balance sheet and the checkbook is usually at the Fed or Congress, and those are the ones that are going to be, I frankly think, will be harder to wean ourselves from.
So I think because Hester will be doing her job so well and having these capital markets get back up and running as they are already, I think those specific pieces of the Fed balance sheet aimed at dysfunctional markets will sort of naturally fade away. But I also agree with Gary. My expectation is that the recovery could be on the weak side after an initial bounce back, and interest rates will need to be low for quite some time. And so the basic Treasury balance sheet of the Federal Reserve will remain elevated for a while until the economy gathers considerably more momentum and the Fed can reinitiate a drop back in that balance sheet.
Well, Gary, Don, and Hester, thank you all very much for spending the past 55 minutes with us. Really appreciate it. Thank you to Brookings for hosting this important discussion. And we will have to leave it there, and I'll turn it back over.
We thank you, and we thank anybody that listened to the 5th panel of the day or whatever we are. So thank you. Stay safe very much. And well.
Right.
Thanks for our final panel. It was really terrific. Those of you who are watching all day know that we've had a very full day. It's been a great way to learn together. This is the first time we've done a joint Brookings University of Michigan conference that's 100% virtual. I hope that you've all enjoyed it. our Center on Finance Law and Policy and the Brookings Institution. I want to thank our partners at Brookings, Aaron Klein and his team. Our team at the University of Michigan did an amazing job putting this conference together. I'm really very, very grateful for everybody participating. Our panelists, I want to thank everybody for participating too, particularly the, of course, irredeemable, not irredeemable, the absolutely wonderful conversation we had over lunch with Chris Dodd and Barney Frank. We had 5 amazing panels on lessons learned from the process, on systemic risk, consumer lending and protection, the current crisis, and of course, this panel on global risk. We had lots of areas of agreement and some areas of disagreement. I think that it is safe to say that the Dodd-Frank Act framework is here to stay. It's resilient. It's setting up the system for the way that we're going to deal with the current crises and crises in the future. Not to say that it is perfect in any way. There's lots more work to do. Our financial system is safer and fairer as a result of the changes that we talked about today from the Dodd-Frank Act. It is safer and fairer, but not safe enough or fair enough. And as we were discussing in this last panel, there are more risks to come from the current crisis, and we need to be alert to the ways in which those risks are going to harm the financial system and eventually reverberate back into the economy where the harm is already being caused today. So we need a financial system that is safer and fairer, one that works better for households and businesses. I hope this conversation today has helped all of us think about ways to improve the financial regulatory system in the coming years. I want to thank all of you who have been watching online for the day, for joining us today. I hope you found it informative and that you'll join us for our next conference, which we're having in November, jointly with the San Francisco Federal Reserve. And it's going to be talking about the central bank of the future, the role of technology in working with central banks to promote financial inclusion around the world. That's November 16th and 17th. It will also be virtual, so you'll have a chance to join us from wherever you're listening today. Until that time, again, thank you. Thanks to all of our wonderful teams at Brookings and at the University of Michigan. Thanks to our panelists for their great remarks and great and engaging conversation today. Take care. I hope everybody stays safe and stays healthy.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.